everyone, this is Dr. T. Varalakshmi and I'm going to be discussing you regarding the payback period or the PBP related problems and the solutions, more related in a practical manner, as well as in the Excel sheet, how they are going to be calculating by using the Excel sheet as per the advanced technologies that are going to be discussing in this particular session. If we see this, the payback period. So generally, if any organization is there, if that organization is going to be, before going to be funding for any activity, whether it may be a purchasing of a machinery, or it may be investing into the fixed deposits, or it may be investing into the any huge projects. If the amount is between the thousands to this unlimited, or if any project undertaken by the organization, so that organizations has to check whether that investments are going to be giving the benefits to the organization or not. So that is a mandatory for every organization. In this regard, some financial techniques are using by the organizations. Such techniques will be called as capital budgeting techniques. Means they are going to be investing the capital of the organization. So that is not belongs to the organization. That is a combination of the shareholders or the investors' funds. Means they have to plan effectively. Planning effectively will be called as the budget. So the capital is going to be planning effectively. So for that planning, if they are using some techniques, then it will be called as the capital budgeting techniques. In this capital budgeting techniques, the normal or the more traditional methods if they use, they are called as the non-discounted cash flow techniques. Simply, if I have to tell you what is a non-discounted cash flow techniques means, if the time value of the money is not taken into the consideration, or a very simple methodologies if they are using for the calculation of these investments can be proceed or not. If they are using this normal or the simple techniques, then that techniques will be called as the non-discounted cash flow techniques, where the time value of the money is not going to be considering. For example, a machinery is there, or let's take as a printer. With that printer, they are going to be investing 25,000. So for the every year, they are expecting the 5,000 revenue with that particular printer. Then we can easily say that for every year, if they are getting 5,000 as the revenue, their investment will be come back within 5 years. So for this one, I'm not taking this time value of the money. This year's 5,000 is worthful than the next year's 5,000. That is, everything is not considering. I'm just seeing how much of time it will take for me to get back that amount which I have invested into the any project or any element. If I calculate, then it will be called as the payback period. Or on an average, if I'm getting 20% of the returns, then if I take it as a average rate of returns. So like this, the payback period, average rate of return, post payback period methods, these are all called as the non-discounted cash flow techniques. If they in the advanced level or in the modern level, if they consider this, even the time value of the money into the consideration, they will be called as the discounted cash flow techniques, like NPV, IARE, profitability index. So all these techniques. Anyhow, in this due course, we'll have the discussion on more problems related to that non-discounted NPV, IARE and PI related problems are also. But in this session, purely I'm going to be discussing you regarding this non-discounted cash flow techniques, that too only about this payback period, and how to calculate manually or by using this Excel sheets, how they will calculate this payback period for the organizations, we will see. So generally, in a short note, it's an acronym for this one is PBP, payback period, or in some jargons they'll be used as the payback methodologies, PBM. payback methodologies, or generally it will be called as PBP methods. So which means the time period which is taking to get back the investments of the organization is called as the payback period. And one more note is, all these techniques are using by the financial manager before the investments are only, not after the investment. Because before the investments are only, he has to forecast what are the cash inflows and the cash outflows. So generally, if they are going to be investing, then it will be called as the cash outflow. If they are expecting the revenues, then it will be called as the cash inflows. So we will denote with cash inflow with CI and CO as the cash outflow, and combinedly we will call it as the cash flows, CFs. So in the short form, if we have to discuss about this amount, investments will be called as cash inflows, or this cash outflows and cash flows. This jargon will be using by this financial managers. They are all like that will be called as this the terminology of this financial aspects. Here is also, in that jargon, if we have to discuss what is the payback period means, if they had the cash outflows, for this cash outflows, the expected cash inflows should be there for the organization. They are not simply assumed, they are all forecasted with this real factors into the consideration. Then the time period which is taking by the cash inflows to cover the cash outflows is called as the payback period. Simply, the time period which is taking of the cash inflows to cover the cash outflows. So for example, if a person has invested 1 lakh rupees of that amount, and if he is expecting per year 10,000 means, we can say that 10 years it will take for him to get back that amount. So for example, if his desired period is 5 years, if that person's desired period is 5 years, and that amount calculated payback period is 10 years means, it is payback period is greater, the payback period is greater than the, more than the expected desired one, so that we can reject that project, because they want to get back the investments within 5 years. That is a desire, but the payback period for this particular investments is 10 years, so that we can reject. But if the payback period, desired period is 12 years, but that project is yielding the benefits within that 10 years only, then that such projects will be accepts. So this is the accept and reject rule for the payback period. So that's why that whatever the theory we have discussed, that is going to be putting in the formula, that is payback period is equals to installments required for a project, investments required for a project divided by net annual cash inflow. So here this annual means every year. So suppose in this given problem, if they have given for the 6 months for or half yearly, the organization is going to be getting for the 5,000 means, we can calculate for the 1 year it will be 10,000. Or for the quarterly, the organization is getting the investments quarterly, they are getting the returns of the 5,000 means, for the 4 means 4 into 5, 20,000. We have to take it as a cash inflow. So that is the consideration of the cash inflows and the cash outflows. Now, let me have the discussion on what factors will be considered as the cash inflows means. For example, revenue generating by the any product will be considered as the cash inflow, but the investments by the organization will be called as the cash outflow. And after certain years, the machinery will be sold. That return, for example, if they have purchased a machinery for 25,000, they have used for certain 5 years or the 6 years of the life period. After that one, if they have sold and they have gained 3,000 rupees, then that 3,000 will be called as the scrap value. So this scrap value will also be considered as the cash inflows. These are called as the cash inflows. Or if a machinery's cost is 20,000 and installation cost is 3,000, now this 3,000 will be called as the cash outflow. Or if for any maintenances and repairs, if they have paid 1,000 rupees, so that will be called as the cash outflow. So machinery cost is also cash outflow, or any insurance premium if they have paid, or any repairs and maintenances bills if they are paying, everything will be called as the expenditures of the organization. Such expenditures for that particular project will be called as the cash outflows, or anything which is going to be getting benefit out of that particular investments will be called as the cash inflows. So that is also be called as the that is also be includes the scrap value, revenue generating, or the any insurance claimed by that particular project or for that particular machinery. Everything will be called as the cash inflow, and whereas the expenditures which are incurring in that particular project or towards that machinery will be called as the cash outflows. This combination of these outflows as well as these inflows will be called as the cash flows. Cash flowing, whether it's out or in. So simply, if we have to see this formula for this payback period, investments required for a project and net annual cash inflows. But there is a twist in this one, that is where the cash flows of the project can be of two elements, especially the cash inflows. Cash inflows for any project may be or even or uneven. So there are two kind of problems are all there while estimating this cash inflows. One is even cash inflows, another one is the uneven cash inflows. For example, if a project is invested and every year the same amount is expecting as a revenue, then such cash inflows will be called as even cash inflows. But if it is varying from one year to another year, then such cash inflows will be called as the uneven cash inflows. For example, in a project, if they have invested 10 lakhs worth of the cash outflows, so that is the cash outflows. Here is also even cash outflows. If any additional amount they have to incur for every additional year, every year if they have to include, then again it will be called as uneven cash outflows, which means one time they have not invested. Every year again some for the repairs and maintenances or for this any maintenance charges or the service charges, if they are all having their expenditure towards that one, then again it will be called as uneven cash outflows. And same as cash inflow. Every year if they are expecting 1 lakh rupees as the returns, if they are expecting 1 lakh as the return every year, same year, this year they 1 lakh, next year 1 lakh, then next year 1 lakh, if they are getting that one, then we can say that such cash inflows are all the even cash inflows. But first year they are expecting 1 lakh, and in the second year, they are expecting 1.5 lakh. And in the third year, they are expecting 2 lakhs. Or in this next fourth year, they might be expecting 1.2 lakhs only. That may be due to this demand factors, or due to the seasonal factors, or due to this marketing factors, whatever it is. So due to their expectations, if it is revenue is fluctuating from time to the time, then the cash inflows are not equal for all the years. They are all different from one year to another year. Such cash inflows will be called as the uneven. So my dears, now as a sum, I would like to tell you the payback period is the time period taking to get back the amount of this cash outflow with the help of this cash inflows is called as the payback period. So these cash flows may be the uneven or even, but these are all called as the non-discounted cash flow techniques. So let us move on to this more problems, practical problems related to this particular payback period based one. The first question is about Due to increased demand, the management of Rani Beverage Company is considering to purchase new equipment to increase the production and revenue. The useful life of this equipment is 10 years and the company maximum desired payback is 4 years, and the inflow and outflow of cash associated with the new equipment is given below. The initial cost of this project is $37,500, means this will be called as the cash outflow. Cash outflow. Next one, they have not given this cash inflows directly, but they have given to us the sales information is $75,000 worth of the sales it is going. You can ask me, madam, can it be a cash inflow if the sales are all doing? Means, see, all the sales is not a profits to the organization. We need to less the expenditure. Then only it will be called as the gains by the organization. Such gains only we have to take into the consideration. So that's why annual cash outflows in the form of the expenditure towards the sales is cost of the ingredients is $45,000 and the salaries expenses are all the $13,500 and the maintenance expenses are all $1,500. So these are all the one. Non-cash expenditures like the depreciation is considered as the 5,000 rupees. And we, by using this payback period, they are asking us to calculate the payback period, and we have to suggest whether the Rani Beverages Company should purchase that particular equipment or not. In this one, particularly, I would like to discuss you regarding this depreciation. Means, if any product is there, due to its usage, wear and tear, time period, or due to the shade out of this any factions and everything, if that value of that machinery is reduced, then that reduction value is called as the depreciation. A bike is there, we have purchased with 1 lakh, while selling, we are selling with this 60,000, means 40,000 is the reduced value of that particular bike, then it is called as the depreciation. And the next a machinery is there, very good machinery, but that machinery's technology is outdated and it is unable to resell, so they are selling with this less cost again, and it will be called as depreciation. Then you might have the doubt that, madam, if that value increases, what it will be called as? Then it will be called as the appreciation. But in the organizations, why they will consider this depreciation means, most of this any fixed assets are only will expect this appreciation, and this non-fixed assets will be expects with this depreciation only. And this depreciation generally calculates by the organization, but it is not a cash expenditure for the organization, because this year if they have paid the tax without having any depreciation, after 10 years, if that machinery lost by the organization, and again they have to replace with this new machinery, but all these years they have paid the taxations to this taxation authorities, and again if they have to invest on the same machinery with they have to replace with the same machinery, means that is one time burden for the organization. That's why this accounting standards has given a facility to the organizations that they need not to pay the taxations for their future certain expenditures. Certainty is there, obviously. If any machinery is there, it won't, they are expecting the lifespan period, means they need not to expect the, they don't say that will be continue for 100 years or the 200 years. They are expecting the 10 years, means it should be 10 years only. After that one, if they have to replace, the organizations has to bear that burden at a one time, means. So the organizations always with a positive perspectives has to keep some savings towards that certainty of the expenditures in the form of this depreciation. And in this payback period, though the organization will shows that depreciation as an expenditure, but really they are not paying, it is non-cash. So that's why in the payback period they won't consider it as the cash expenditure. So this one we don't need of that one. Next thing is, if we goes to this given date of this particular elements, the useful life of this equipment is 10 years. They are expecting the life of that machinery is 10 years, and their desired payback period is 4 years. Then they are expecting the sales of 75,000 with a cost of 45, 13, 5 means the total cost of this one is 5 plus 3, 8, 9, 10, 60,000. 60,000 is their expenditure, and so that they can expect the cash inflows for every year. Why, ma'am? And every year you have considered means here they have mentioned annual cash inflow. So annually they are expecting 15,000 as the returns. So 37,500 divided by 15,000. So nearly 15 twos are 30. That is 2 point something. So 2.5 years are only they will get back their amount. Their desired is up to 4 years. Even if that payback period is more than 4 years, they can go for this purchasing. More than 4 years, they should not go for the purchasing of that one. Up to 4, they can purchase. But they are getting back their investments within 2.5 years or only. Then it is better to go for the purchasing of this particular machinery by the Rani Beverage Company Limited. So that suggestion we have to give after doing all this analysis. This is orally only, but let me have the discussion on. So how to calculate this step-by-step procedure. The step 1. In order to compute the payback period of this equipment, we need to work out the net annual cash inflows by deducting the total cash outflows from the total cash inflows associated with this particular equipment. So here is the same. They are expecting the sales of 75,000 minus all the costs incurring to that product is equals to 15,000. Now the step 2 is, now the amount of these investments required to purchase that particular equipment would be divided by the amount of the net annual cash inflows to find out the payback period of this equipment, because we know that one payback period is equals to investments required for the project is $37,500 divided by net annual cash inflows are 15,000. It is between 2.5 years. It is the 2.5 years means, and so the depreciation is a non-cash expenditure, so that's why we have not considered it as one, and that too it is less than the expected payback period. So it is better to purchase that particular equipment by the Rani Beverages Limited. So it is one choice is there for the organization. Only that choice is going to be evaluating here. For example, 2 machineries are all there. One machinery, second category of the machinery. Any one only they have to choose out of this first machinery or the second machinery. At this stage, they will see that suppose the first machinery's payback period is 2 years, the second machinery's payback period is 1.5 years. As per the payback rule, it is better to purchase the second machinery because they are going to be get back their investment back within 1.5 years or only than the 2 years they have to wait for this first one. So that is another interpretation rule. If the more than two or more projects are all there, and if out of that one they have to select one or a few they have to select, based on this interpretation or this rule, they will choose the best project for their investments. Some more problems we will see. That is the one. Second, ABC company requires an investment of $220 is expected to generate the cash flows in the 6 years of the first year 70, second year 60, third year 55, and fourth year 40, and fifth year 30, sixth year $25,000 respectively for all the years. And if we have observed this one, this 2,20,000 is the cash outflow, and these are all called as the cash inflows. That too, what kind of this cash inflows means? Uneven cash inflows. They are not even for all the years. Now, we need to compute this payback period of these investments. Should the investment be made of management, what to recover the initial investments in years, 3 years or less. So, which means that desired payback period is 3 years. If it is more than 3, reject. If it is less than 3 or the 3 equivalents to 3, then we can accept. If we have seen this one, the initial investments is $2 lakhs, and here at this elements we need to use this formula, that is payback period is equals to years before the full recovery plus uncovered cost at the start of the year divided by cash flow during the year. So which means every year and the cash inflows expected one we will take. And because they are all the uneven, we need to take this cumulative cash inflows. In the first year, if they are getting that 70,000 means 70,000 they are getting. And with the including of the second year 60,000, they are going to be get cumulatively 1,30,000 rupees of the amount for that particular investments. In the third year, they are going to be get back this 55,000 at additional means. So cumulatively, they are going to be get 1,85,000. And in the fourth year, 40,000 they are going to be earning means 2,25,000 is the fourth year cumulative value. Same as with fifth year and the sixth year. So combined, they are going to be get back this 2,80,000. But what the payback period sees is, they don't want after their investment amount whatever they get, but they want to calculate the time period taking to get back their investment back only. So the investment is 2 lakhs means this 2 lakhs is between 1,85,000 and 2,25,000. So which means the payback period will be between 3 to 4 years. More than 3 years and less than 4 years. So in maybe in some months it will be varies. So for that calculation, so we have taken years before full recovery. So full recovery will be get at the fourth year, 3 to 4th year, but the third year they are going to be get back before this year will be called as the before the year. So that is the 3 plus unrecovered cost at the start of the year means, so here 2 lakhs they have invested. Up to 3 years, they have get back the investments of 1,85,000. Means the unrecovered amount here is $15,000. $15,000 they have not yet recovered divided by. But this 15,000 they have to receive. But this entire year, the next year, they are going to be get how much of amount? 40,000. So for the entire 12 months, they are going to be get 40,000 means for the 6 months it will be nearly 20,000, which means so it will be below the 6 months only. So below the 6 months only. So that is 3.5 months or 3.44 months days it will be comes. So that calculation only we are doing with the using of this particular formula, that is payback period is equals to 3 plus 35,000 in divided by 40,000, that is equals to 3 years plus 0.875, that is 3.875. So even if you want to convert into these points into this months, so 3 years 0.875 year has to convert into months means we need to multiply with 12. So 12 into 8, 96. So 97 around with the points we can calculate. So 3 years. I'm so sorry. Here it is for this previous problem. It is 2,20,000 is the investment. 2,20,000 is an investment means so 1,85,000 minus 1,85,000. 2,20,000 minus 1,85,000. Then it means 15 plus 20, 35,000. This is 35,000 divided by that year they are going to be get 40,000. Now it will be more than this one. So 3 plus 0.875 means 3 years, 9.6 months, 9.6 months, because 0.875 into 12 means 9.6 around or 9.7 around. So 3 years, 9 months. Even if we wants to convert into this 0.6 into days are also. So days means into 30. So 6 into 3, 18 days. So 3 years, 9 months, 18 days it will take to get back their amount. Or you can simply kept it as in terms of these years. Now, if we have seen this, observe this problem, they have said that they wants to recover that initial investments within 3 years. But actually the time period taking to get back their investment back is 3.875 means. So desired is less than the expected one. So simply the project is therefore not desirable or the rejected, because the payback period of the estimation for that project is more than the desired payback period of the company. The same one, if we see this next problem related to this payback period, an opportunity arises for a company which requires an initial investments of $8 lakh now. The management discount rate is 12% and the amount of cash inflows expected for the new opportunity are: year 1 cash inflows are $2,50,000 and the year 2 cash inflows are $4 lakh, year 3 cash inflows are $3 lakh, year 4 cash inflows are the $4,50,000. Then compute the simple and discounted payback period of this new investment and new investment opportunity, and is the investment opportunity acceptable under the two methods if the maximum desired payback period of the management is 3 years. Here if we have seen simple payback period as well as discounted payback period. Always the discounted means the money value is taking into the consideration. Simple payback period means non-discounted. The same thing we can see in the discounted values also. How to calculate that one we'll see. So in the simple payback period method, so anyhow the initial investments of that particular project is 8 lakhs. Initial project is 8 lakhs, and in the year 1 the cash inflow is 2,50,000 and the cumulative 2,50,000. Second year 4 lakhs means cumulatively they are going to be get 6,50,000, and in the third year they are going to be get 3 lakhs means cumulatively they are going to be get 9,50,000. The remaining totally they are going to be get 14 lakhs of this written as the amount. But this 8 lakhs of the investment is between the 6,50,000 and 9,50,000, so that we can take this as the uncovered years, that is 2 plus the amount to be recovered, that is 8 lakhs minus 6,50,000, that is 1,50,000 divided by this year's investments, that is 3 lakhs. 0.5, that is 2.5 years. 2.5 years. So as per the simple payback period, it is better to accept the project because this desired payback period is 3 years, but within 2.5 years are only they are fully recovering that investments back. So as per the simple payback period, this project has to be accepted. But in the discounted payback period, in the problem itself, they have mentioned the discount rate is 12%, which means if today 1 rupee is there, if it tomorrow, if we get the same 1 rupee, not this tomorrow exactly not 1 rupee, or after 1 year if we get this 1 rupee, today with this 1 rupee, for example, we are getting 1 chocolate. The same chocolate value for the tomorrow is become 1.12 rupees. So which means this 1 rupee value is today's money is worthful than tomorrow's money, because if you have today 1 rupee, you are going to be purchasing 1 chocolate, or you are going to be investing into the another one, and you are going to be generating that funds. And today, if you are not getting that 1 rupee, after 1 year, if you get that one, by that time the prices of these goods are all increased, or even you have lost this last year investments returns. So that's way you have lost this time value of this money. So that reduction rate of the particular rupee will be denotes with this discount rate. So that's why if they have mentioned discount rate means it will be called as a discounted cash flow techniques we have to apply. So with this one, so generally we will use this formula 1 divided by 1 plus r to the power of n. For the number of years and the rate of discount rate. Even if it is not there, simply you can go for this annuity tables, present values, PV values we can take into the consideration. In most of these examinations, some examinations they may give you they may give you this annuity tables or may not give you. So if the annuity tables are not provided, we can use this simple formula and we can calculate this PV factor values. That is, present value factors 12% is equal, if they have given this 12% or the 10%, this value will be taken as R value. And for the number of years, first year, second year, third year, fourth year, like this, the number of years will be taken as N value. For example, for this 12%, if today is 1 rupee, if its discount rate is 12%, after 1 year, if we want to calculate that 1 rupee value is 1 divided by 1 plus R value means 12% means 0.12 whole to the power of, if it is for 1 year means N is 1 value. So this given value will be called as, that is 0.893 means the value of the rupee is reduced to 0.893 because its 12% value is reduced. Then after second year, if its value, if we wants to know, same 0.1 divided by 1 plus 0.12 whole square value will take. So that value is 0.797. So which means if you have today 1 rupee, then you are going to be get back after 2 years its value will be 1.797. If this after 2 years if you get 0.797 means that today's value is 1 rupee. So like this, the present value of this particular discount factors or this cash inflows will be calculated. For 1 rupee, if they are calculating means if we multiply with this number of the cash inflows, then it will give the value of this entire cash inflows. So that's why for every year 1, 2, 3, 4, 5 years cash inflows respectively, what they have given is 2 lakh 50, 4 lakhs, 3 lakhs, 4 lakh 50,000 and everything they have provided. And we have calculated this present value factor with a discount rate of 12% for every year, 0.897, 0.797, 0.712, 0.632. So this is for 1 rupee values are all. And if you want to calculate $1 value it is, and if you want to calculate it for $250,000, you will simply multiply this with this column, then it will become $2,23,250. So which means after 1 year, if you are going to be return, if you are going to get that $2,23,250, or that's value today is 2,50,000. So cumulative value anyhow, first year means same value it will be. Second year, 4 lakhs you are going to be get, and the PV factor if you multiply, its value is reduced to 3,18,800, and cumulatively if we add these two numbers, then it will be called as $5,42,050. Then third year 3 lakhs with the multiplication of this PV factor, we will get $2,13,600, and cumulatively of these two values will be called as $7,55,650. And the same as with this 4,50,000 and 0.636, so it's 2,86,200, and cumulatively 10,41,850 they are going to be get. So if we apply this same payback period one, this now the 8 lakhs is between these 2 years. So this will be third year will be called as the base year, and the fourth year next cash inflows will be this one. So that if we calculate this one, 3 plus Unrecovered amount 8 lakhs dollars minus 7 lakh $55,650 divided by this particular year they are going to be get 2 lakhs $86,200. So if we calculate this value, it will be become 3.15 years. That means 3 years. 0.15 into 12. 0.15 into 12, which means 3 years, 1 month, 24 days, etc. Nearly of 3 years, 2 months time period it will take. But the desired payback period is 3 years only. But with a discounted cash flows, that is more than, it is taking more than 3 years, it is taking more than 2 months it is taking. So as per this discounted payback period, this project is not accepted. So choosing of the project is the purely based on the choice of these organizations. The organizations may accept or may not accept, but whether they are following this method of the simple payback period or the discount payback period, it is the choice of the organizations. So that is about the discounted payback period calculation as well as non-discounted payback period calculations. If we say this one, problem 4, Caterpillar Incorporation is considering the purchasing of furnitures and fittings for $30,000. Such furnitures and fittings encompasses a useful life of the 15 years and its expected annual cash inflow is $5,000 and the company's preferable payback period is 4 years. You need to find the payback period of this furniture and fittings and conclude whether or not buying such furniture and fittings is desirable. Now, the simple one only, how it will be calculates in the Excel sheets, I'm going to be explaining you. In this one, I hope all of you will know this Excel sheets. Rows will be denotes with the numbers 1, 2, 3, 4, 5, 6, etc. Unlimited. And the columns will be indicates with A, B, C, D, A, B, B, like this they will indicate. So now, in this first column, same information only, but we are taking that in the first column, Caterpillar's incorporations and fittings and furnitures amount column, separate columns. So in this one, total investments required is $30,000. Net annual cash flow is 5,000. Actually, what is the formula? The investments divided by net and cash inflows. So we will use this formula. So here it is at B2. The address of this particular investments is B2. So B2 divided by the address of this cash inflows is B3. So B2 divided by B3 formula we have given simply. So now the payback period in terms of the years, it is automatically calculated as 6 years. Same we can apply for this n number of projects, 10 number of projects. If you simply entered what is the total investments or total cash inflows, so if you use that formula will be paste or you can calculate easily for this particular one in the Excel sheet. So next one, if we see, the Boeing company is considering purchasing an equipment for $40,000 and the equipment has a useful life of 15 years and its expected annual cash inflow is $40,000, but the equipment has an annual cash outflow including preservation expenses of $30,000 as well. The aircraft manufacturer's desired payback period is 5 years. Should Boeing purchase a new equipment? So the given data is the total investment of this particular project is $40,000. They want to invest. And the net annual cash inflows are net annual cash inflows minus annual cash outflows, that is 10,000, because they are their cash inflow is 40,000, cash sales is 40,000 and cash outflow is again annually they are going to be again investing 30,000 means net amount they are going to be get that return as $10,000. Now, if we have to calculate this payback period, then total investments of that equipment is $40,000. Annual cash inflow is again $40,000. Annual cash outflow. This is total first time they have invested, but this is the every year they are going to be again additionally they want to invest means. So here the cash outflows are uneven. So first time they have invested 40,000. Again every year they are investing 30,000 as in a part of any repairs and maintenances or any additional expenditures. So every year, though they are getting $40,000 of the benefit, but in this one every year again they are spending 30,000 as the expenditure. So on an average, not an average, net amount they are going to be getting as only 10,000 as the benefits. But the initial investments is 40,000. Every year they are going to be get 10,000 means the payback period is 4 years. And that too, we have here the formula or the address bars is changed. So here the B2 column we have the total investments at this one, but we are not divided with annual cash inflows. The net annual cash inflows values are only we need to take. So the address of this net annual cash inflows is B column, 5th row. So B5 we have given so that it has calculated at the 4 years. So the software will gives you the flexibility in calculation only, but the knowledge of calculation and the formulas we have to learn. So that is that will always helps you to find the errors and rectify the bugs and everything again. So the next one, problem 6, if we see this one, suppose Microsoft Corporation is analyzing a project that requires an investment of $250,000 and the project is expected to come up with the following cash inflows in 5 years is, in the first year $80,000, second year $70,000, third year $60,000 and the fourth year $50,000 and the fifth year $40,000. Now, they are asking us to calculate the payback period of these particular investments. Also, find out whether the investment needs to be made if the management is wants to recover the initial investments in 4 years period. So here, simple one only, but have to calculate in the Excel sheet. I'm going to be explaining you. In the first column, we have taken the number of years. In the second column, annual cash inflows we have taken. And this third column, we have taken cumulative cash inflows. Here we can give the formulas. So because the first column as it is, same, this is 80,000. This is 80,000. We have copied here. And this particular address bar will be the combination of this C1 plus B1, B2 plus B3. Or you can use this another again also C2 plus B3. C2 plus B3. So that while copying the formula again, if you keep on copying this formula, if you keep on, there will be a drag button will be, we can find in this Excel sheet. If you drag on this one, it will increase as C3 plus B4, C4 plus B5, C5 plus B6 like this. So n number of cumulative values if they have given, but all these values we can take. So anyhow, initially it is the combination of these two values or these two values. Both are same. C2 plus B3 or B2 plus B3. Both are same. So no doubt in that one. So next continuation is C3, this column plus this column. So now note this, the fourth year we have got the initial investments of 2,50,000. So this payback period will be called as, so in this fourth year, we are going to be get back this 2,50,000 rupees of the amount, means it will be between 3 to 4. That is 3.11 months, etc. 11 months, etc. So for that one also again how to calculate that one we will see. So now we have to calculate first what we need to take is completed years are all Here it is 3. So 3 means A4. Its address bar is A4 plus B10 divided by. So that is B10. So B10 divided by. So unrecovered cost. So again he have given the total investments needed is 2,50,000 and unrecovered cost of this year is 40,000. For this one also again you can use this formula. That is B9 minus initial investments if you have taken B9 minus the amount at C4. If you have given this one B9 minus C4, this value will be automatically calculated. B9 minus C4, it will automatically calculate. Now the B10 value is 4,000 divided by annual cash inflow payback period, or this one also, this B11 annual cash inflow is B11, or yeah, for this one you can say that B5 value. It is equals to B5 value. So same value it will be extracts here. Or you need not to take this one also. B10 divided by B5 value you can give in the formula bar. Then automatically it will be calculated as 3.8. 3.8 means 3 years. 0.8 into 12 means 96. 9.6, which means 3 years, 9 months, 9.6 months. Again 0.6 into 30, 18 days. So like this we can calculate. The desired payback period is 4 years. It is more below the payback period only. So it is suggested to purchase the particular machinery. But how to calculate in this Excel sheet I have shown you as per this address parcel. The next one, find the payback period of the following series of cash flows. If the cost of the capital is 13%, then CFO, cash flow at the initial year. So 0 means at the base year. So minus $1,20,000 means that is we can treat it as the initial investments of the organization. And cash flow at the first year is $30,000, second year is $40,000, third year is $55,000, fourth year $50,000. Now, by having this data, we need to calculate the payback period. So, how to calculate that one? We'll see. The cost of the project is 1,20,000. And cash flows we have given. So here all this 0 year it is minus value it is kept, and in the first year 30 and 30,000. This is then another method I am going to be explaining you. First year 30,000 they have recovered means how much of amount they have to recover again? 90,000 they have to recover. Then in the second year they got 40,000 as a return means. So 90,000 minus $40,000, it will be become 50,000. Still in the minus balance, it is minus 50,000. 55,000 they are going to be get means 55,000 they are going to be get means here they are going, it will be plus 5,000 because minus 50,000 has gone plus 5,000. And the next year they are going to be get 50,000 means, so again it will be become 45,000. It is now it has become plus value. So where we are going to be get this plus value? Here we are going to be get this plus value. So here the payback period is A, the third year, plus B value, that is 5,000 divided by the next year that we get 50,000, that is 3.1 years. 3.1 years. So like this we have to we can use this particular elements are also, that is backtracking method. So 90, 40, if it is less 50, again 55 means again they have to recover 5,000. So like this they can minus values we can take into the consideration. So this is all about the calculation of the payback period at different methodologies when the cash flows are even or uneven, and there too have to treat this cash inflows. So before the discount, we have to consider this cash flows with a discounted value or with a non-discounted value, or we can make it as from minus to plus values, and we can calculate this payback period again. So and by using this excel sheets, we can prepare for one project, means we can use that same formulas for the n number of projects that can be useful for all the kind of the projects. So that is about the calculation of this payback period when the cash flows are even, uneven, and that too the payback period with the discounted cash flows as well as with the non-discounted cash flows, and that's different types of the methods how to calculate that one using the excel sheets and everything as discussed in this particular part. So thank you so much.
Like, share and subscribe. Hit the bell icon for more updates.